Good morning, everybody, and it's 10:08, and I know we're a few minutes late, so apologize for that, but they had a special MAPS meeting that they had to get done. So item 1 is called to order. Item 2 is we have 2 presentations, and Jake, you want to start first and tell us something, and then we'll get the presenters up?
Sure. We've spent a lot of time making some slight modifications to the portfolio with the addition of commodities and some other things. Now we just want to get back into the routine of hearing from some of your existing managers. This morning we have your 2 small cap managers, Times Square and Earnest. Times Square being the small to mid growth, and Earnest is a small to mid value strategy. And just a regular routine update on their firm, organization, and their portfolio. I'm not sure who's first. I think Ernest is first, so I'll let Pat step up to the...
Good morning, guys. You got 30 minutes, and we'll go from there.
Okay.
All right, sir.
Okay, well, good. Well, first of all, good morning. Thanks for having us out. It's been a little while since we've given an update, and as Jason mentioned, we do manage the SMID value portfolio on your behalf. My name is Patman Malcolm. I'm actually one of the partners at Earnest, and with me today is Richard Burgess. Richard is a member of the investment team, and our plan was to refresh you just quickly up on who Earnest Partners is and our style, and then get into the portfolio itself. So Earnest Partners, we're an employee-owned asset management firm that has a bottom-up approach, and that means that we're not trying to go out in the world and make macro forecasts. We're going out and saying, let's go out and let's find good individual companies that we think can outperform over time, and we'll take into consideration the macro events that are in place at the time to determine whether or not that's a conducive environment for that particular company to do well, and also the valuation. And then from there, build out a portfolio that has about 60 stocks on your behalf. Now, we've been with you for a while, and over time, the portfolio has done well. In fact, since inception, it's up over 12% annualized since we've been with you. So we'll go through some of the details there. One of the things that is a little bit unique about the way we approach investing is that when we've built our team historically, we've always had the idea and the philosophy that if you can look at an investment from 2 different perspectives, that over time that gives you the best way of finding good companies. And those 2 perspectives are, one, you want to be able to look at it from the standpoint of an analyst, in terms of looking at it from a valuation standpoint and everything else, but also from that of a practitioner. So everyone on our investment team has spent time in industry, not the investment management industry, but in the industry, in an industry that provides products and services, or maybe some functional industry, whether it's accounting or capital markets or whatever the case may be, so that when we go out and look at a company, we can look at it from the perspective of having been in those shoes before. So if you look at the person that covers industrials for us, he worked as a lead engineer for Ford and actually responsible for their powertrain system on 4 of their most successful vehicles. So has a very good understanding of how an industrial company works and what it takes to go from having a blueprint of an idea, putting it on an assembly line, and getting it out in the marketplace. Over time, you've been introduced to different people on the team. Richard is a member of the investment team as well. He has a transportation and logistics and military background. He actually went to West Point, has a degree in physics, actually was the #1 graduate from West Point in physics, spent time in the military, very focused on transportation, logistics, and part of that responsibility was actually working with a lot of the clients that we are looking to make investments within today. And the list goes on and on. So if you looked at the person that covered energy for us, or if you look at the person that covers telecom or consumer or whatever the case may be, with the idea being that once that team sits together and sits around and starts to talk about a name, you've got a lot of different perspectives and judgments from which to look at that name. So that's just a quick refresher on who we are and how we operate. You have the book in front of you. There's a short background information on myself and Richard up front, but we'll go ahead and move on to what's important to you, and that is your portfolio. I'll start with the guidelines. We do manage the guidelines for this portfolio. Generally speaking, within the SMID space, we're buying names that kind of fall somewhere between $300 million up to kind of $12 billion. There's not a bunch of guidelines here, which gives us the freedom to go out and identify opportunities where we think there is the most value. But to the degree there's any changes there, please let us know, and we'll take that into consideration. There's a market review. I won't read through that, but just to give you a little flavor on some of the things that we've seen in the marketplace recently, one of the biggest themes that's affected the markets and affected investing over the last kind of definitely since the last time we met with you, and now we're kind of running up on 3, 4, 5 years of it, has been a very low interest rate environment and people's search for yield. And I know that you work with Jason in terms of managing that from an overall portfolio standpoint, but that also has an effect on just the SMID value space. And one of the things about SMID value, when you look at the benchmark, which is what we're measured against, you're looking at about a pretty significant, close to 20% of your portfolio in utilities and REITs, which are REITs, real estate investment trusts, which are very interest rate sensitive sectors. And as interest rates have been so low, a lot of people have been referring to these sectors as fixed income surrogates. So people that can't get the yield that they want from the fixed income environment, they've been looking to places in the equity market where they can get that yield. And those are two areas that historically have had high dividends, and so people have gone there, and they've done well because of that, not necessarily because the fundamentals have changed over time. So that's something that we've managed on your behalf within this portfolio. I would also say that the last 5 years has been a strong rebound from what happened in 2008. There's been some volatility associated with that, and valuation has become a big question. You look back 5 years ago and you compare the valuation levels then to what we're seeing today, and it's very different. People look back now on 2009 and say, wow, that must have been such an easy environment from which to invest in because everything was so cheap. And then people are looking at the world today and saying, hey, are you able to find opportunities when valuations seem a little stretched? Now, the reality is going out and picking securities, it doesn't matter what environment you're in. It's always tough. It's always a tough thing to do, and a lot of times it's a relative game. So 5 years ago, a lot of things were less expensive, but we were still having to go find the best relative value in that less expensive environment. And people tend to forget that in late 2009, there was still a lot of uncertainty with regards to what had happened to 2008 and the ramifications there. As we look at the world today, things have gotten a little bit more expensive, and that's been a benefit because over the last 5 years, this portfolio has performed very strongly. We look at the world today within the SMID value space, and we are finding opportunity. If you kind of adjust the current environment based on inflation, based on interest rates, there's still opportunities out there. One of the beauties of our job is that we don't have to go out and buy the entire market. We're just picking the 50, 60 securities that we think have the best prospects over the long run. So those have been some themes, and we talk about that in the commentary itself that we've invested around since the last time we met with you. If you turn to page 4, what you'll see here is just how the benchmark, the Russell 2500 value has done, and we put it in here for the quarter as well as the year-to-date period. And you can see that utilities has been one of the better performing sectors for the year-to-date period and for the quarter-to-date period. A lot of that a function of what I'd mentioned earlier about rates. Within financials tend to be broken down into 4 different areas. You've got REITs, diversified financials, you've got insurance companies, and you also have commercial banks. Of those four, REITs have been the best performing area. We don't break REITs out here, but within financials, that's been the other really strong performing area in the recent past. Okay, if you go to the portfolio review tab, this kind of gives you some details on the portfolio itself. It gives you an ending portfolio value. This is all as of June 30th. You can see an associated income there and an implied yield of about 1.2%. We don't manage the portfolio to go out and structure it so that it has a high yield or a low yield. Really, though, we're looking for companies that have better opportunities to invest their capital than just returning that to shareholders in the form of a dividend. So over time, you'll see that we tend to have a yield that's a little bit lower than the benchmark. And then at the bottom right-hand chart, you can see that the portfolio is fully invested, about 3% in cash as of the end of the quarter. That's just a snapshot in time. And what you'll find is over time, cash does stay down less than 3%, unless there's something unusual where we can't find opportunities to invest in. On the next page, you'll see performance. Share a couple different time periods for you. For the most recent quarter, the portfolio is up 5%, a little over 5%, 5.1. Benchmark up at about 4.2%, so a little over 90 basis points of relative outperformance. Year to date, outperforming by about 136 basis points. For the past year, you can see the portfolio is outpacing the benchmark by about 500 basis points. And then since inception, you can see strong annualized rate of return since inception. Now, our industry always likes to talk in percentage terms, but we know that you pay out your benefits in real dollars. You can see on the next page what that asset growth has looked like historically. We incepted with you at about $17 million. Since then, you can see a net withdrawal, and then over time, the portfolio has generated about $40 million in actual dollar return, and that gets you to your ending balance on that page. Now, for us, what matters is, can we go out in the world and find good individual stocks? We don't sit around and try to forecast interest rates. We don't try to forecast GDP. We don't think that's our skill set. Instead, what we try to do is go out and find individual companies. And if you were to look at our portfolio historically from an attribution standpoint, whether we're overweight a particular sector or underweight a particular sector, over time, that tends to wash out. There can be periods where maybe for a year or a quarter, like we've seen here recently, where that will have an effect on the portfolio. But over time, what really matters is, can we find good individual stocks? And so in the presentation, we've shared several names on the next page. We won't go through all the different names, but we thought we might take a couple minutes and just talk about some of the names in the portfolio and then what your portfolio looks like relative to the benchmark.
So as Patman mentioned, portfolio performance has been driven by stock selection over time. And just wanted to highlight one of the names on this page, and that's CBRE. You may be familiar, you may have seen their signs. They're one of the largest commercial real estate services firm in the world. And they have very good market position in the most important markets within North America, Europe, and in Asia. And this company really is in the business of providing services to owners and tenants of commercial real estate properties. So anything ranging from an office building to even a shopping mall and everything in between. And so what this company does is facilitates sales and leases, and they also provide facility management services. And this is an area where we believe the street is not giving full credit for the opportunities that the company has to basically benefit from the outsourcing of facilities management as more and more owners look to outsource the operations of a particular facility to a company like CBRE. Just given their density within particular markets, we see them as being well positioned to take share from smaller, less well positioned competitors. And we don't think that despite the strong performance this company has had, I think the shares were up about 17% in the most recent quarter. We still don't think that that opportunity to take share from competitors in the facilities management business is fully factored into the stock. And I think just more broadly speaking, the environment for commercial real estate transactions has also picked up somewhat, and that's kind of a tailwind at this point in the cycle for the company. Turning to the next page, this is page 9. This gives you just a sense of the breakdown of the portfolio, where we have industry over and underweights. And as you can see, your portfolio is the blue column on the left, and then the benchmark, the Russell 2500 value, is the column on the right in red. And you can see that we're underweight to financials, underweight to real estate investment trusts, as an example, also underweight to utilities, so those fixed income surrogate the type investments that Patman talked about. But where we are overweight are some of the more economically sensitive areas, like industrials and materials. But one place where we actually did have a transaction in the quarter, we actually sold a company called Amcol. Amcol, during the quarter, there was an announcement from a peer company that it was really an offer to acquire the outstanding shares of Amcol. So this is an example of a company, a strategic purchaser, looking out at the marketplace and seeing what's on sale. And in the case of Amcol, the financial markets, the street, Wall Street, wasn't fully factoring in the opportunities that a strategic player could see. So this strategic player was called Mineral Technologies. And what Amcol does is they actually have one of the largest businesses in the world in terms of providing bentonite clay. Bentonite clay is a material that's used in a variety of different applications, ranging from everything from kitty litter to actually steel castings. So this company was very well positioned, not just here in North America, but also globally. And this company, Mineral Technologies, saw the value that was incumbent in the portfolio that wasn't being recognized by the street. And as a virtue of the fact that this stock was in your portfolio, you benefited. The shares were up about 35% following the acquisition. So I think I might just leave it there and just open it up for any questions that you might have.
Any board members have any questions? Go ahead.
Would you say in the last 12 months, most of your success has come from the small or the mid-cap area?
It's been a mix. It's been a mix. I would tell you that within the last 3 months, more of it's come from the mid than the small, as small has tended to pull back, and there's been more concern about valuation within small cap than mid. But right now, it's about a 50-50 mix.
And just to follow on that, the median and average market cap appears to have trended up some. Is that
Yeah, that's been a function. You'll see that start to come now. We've had some mid-cap names in there that have done particularly well. Actually, one of them being One Oak, which you might be familiar with, has done particularly well, and it kind of ran up above that mid-cap range. It's since been sold out of the portfolio. And we've got a couple other names in there that are a little bit larger. So if you were to kind of strip out the top 3 or 4, it would pull back more in line with the SMID benchmark, and you'll start to see some of the bigger names come out.
just a couple of overall firm questions?
Yeah.
What are the assets in the SMID strategy now, and what have been the flows?
Yeah, so within the SMID space, it's about $2 billion in terms of assets. In terms of flows, this is a strategy it's been closed down to new investors. I would tell you that as we go around the country and the world, really, and you look at kind of allocations from a plan sponsor standpoint, there hasn't been a lot of changes within the domestic equity lineups. So that's been fairly stagnant there. So flows have basically been pretty flat.
The SMID is closed. What about small cap?
The small cap is closed.
Both
Yep.
are closed.
Yep.
And then just at the firm level, any organizational changes?
Yeah, the only thing I would bring up is that we are employee owned, which we think in our business is the best form of ownership, biased opinion. We did have 2 members of the team that were promoted to partner within the last quarter, a gentleman named Jesse McGee and Chris Hovis, who've been at the firm for about 8 or 9 years now, and they were promoted to partners. So from an ownership standpoint, that's changed.
So how many individuals have an ownership interest in the firm?
Yeah, there's 8 partners in the firm.
And what is Paul's ownership interest?
Yeah, so Paul is our founder, our CIO, and he has a little over 60%, and then the rest is distributed amongst the other partners.
And has that been coming down? Is that
Yeah, I mean, as we brought on new partners, everyone got diluted.
everyone is? Or
Yeah, everyone gets diluted. So historically, it was just kind of Paul getting diluted. Now everyone's getting diluted. He'll always be above that 60% threshold, at least in the near future. Yeah. The other thing I'll point out is that this quarter, we kind of reported everything as of June 30th. We actually owned a company called Protective Life, and so you'll see from a transactional standpoint, they're an insurance company based out of Alabama. They were just purchased at a 40% premium from a Japanese insurance company. So that is some additional transaction that you'll see this quarter. We didn't really address it here, but it was a good thing for the portfolio in terms of them being acquired at a premium.
So as that's happening, are you redeploying more in the smaller caps more compelling from a valuation standpoint now that the market's sold off, or are you still finding?
Yeah. So we don't really look at it like that per se in terms of, hey, we sold a name, so let's go try to find something within the small cap because it's more attractive. We're getting up every morning and saying, hey, here's our beginning universe, the Russell 2500, and based on that, where is the best opportunity lie? And so since that transaction, we haven't bought a new name. So we haven't redeployed it, and it could end up in a small cap name. It could end up in a mid cap name.
Just where the best opportunity.
Yeah, it's wherever the best opportunity is. And the reason we like the SMID space, because it does give us the opportunity to move where there is the best opportunity, but we don't really, from a mindset standpoint, we don't break it up as we got to have a certain amount of small, we got to have a certain amount of mid, and hey, if valuations are more attractive in small, then let's go hunt in the small cap space more. We just say, look, here's the universe. Let's go find the best opportunity. It very well could be the case that, hey, valuations have pulled back in small cap, but the reality is there could be a mid cap company that people just don't understand the story. In fact, Huntington Ingalls, a perfect example of a name that Richard brought to the table, is a shipbuilder. They were owned by General Dynamics historically. General Dynamics split them out, and when they got split out, there was a lot of headwinds associated with the shipbuilding business because they were a small subsidiary of a bigger defense contractor, General Dynamics, and so they were trading at a pretty significant discount to what they should be, and we kind of seized that opportunity just because we realized, hey, the market isn't valuing them based on a standalone entity now, and certain of the contracts they had with the government as they rolled off, and Huntington Ingalls didn't renew that because it was negotiated with General Dynamics, and they focused on the higher margin piece of the business. It took a little while for the market to realize that, hey, the margins of this business are expanding, and so they should get the credit for that. But as that happened, this is a name that, mid-cap name we bought, and it's up 40% since we bought it. So we're just trying to take advantage of where the opportunity comes up as opposed to trying to manage where in the market cap spectrum we want to play.
Any other questions? Yeah. You all have anything else?
That's it.
All right. Well, thank you so much.
Well,
Appreciate
thank
it.
you.
All right.
We appreciate it.
All right. And Joseph's up next. Well, good morning, sir. You got about 30 minutes.
Sounds good. Good morning, Mr. Chairman.
Okay.
Good morning, trustees, and thanks very much for your invitation to come to you this morning. And it's a good thing the podium at least is not too bad. I sometimes get a little concerned that I have to step on something in order for you to see me, and I'm sure the last thing you want to hear this morning is an investment manager on a soapbox talking to you this morning. So before I begin the formal remarks for the presentation, just on behalf of myself and the rest of my colleagues back in New York, thank you. Thank you for your continued business You've passed your 4.5-year anniversary with us, and I can tell you with 1 out of my 3 kids, the youngest about that age, it requires a bit of a patience sometimes to stick with a manager, but we certainly appreciate your continued business and support. I thought what I'd do this morning in the brief 30 minutes that we have is provide you a brief update on the organization. I know it's been a while since someone from Times Square has been here. Some of you might have met my colleague Jeff Bramer attending these meetings in the past. Jeff is on vacation. I'm here in Oklahoma City. I think I've got the better end of that deal. But and Jeff stands all of 6'2". I'm 5'2", but it just shows you we do span the entire height gamut at Times Square, not just from an investment perspective. If I can ask everyone to turn past the first tab, just some quick comments in terms of an update on the organization. And those of you who have followed our company before know that we generally don't have too many updates to provide, and I'm happy to confirm that for the board this morning. We continue to be focused from an investment management perspective. All we do at Times Square is growth equities, with a primary focus on small cap to mid cap in terms of the investment space. We're also focused from a client perspective. We only manage assets for institutional clients such as yourselves. We don't do any retail. We don't do any brokerage wrap. In our humble opinion, we think that would be a bit of a distraction for both the client servicing team as well as the investment team. Now, as far as the team of professionals that we have, it's still that same structure that you've seen at past meetings, with 2 portfolio managers at the helm and a team of 8 very seasoned sector analysts that are supporting this team. And we'll take a quick look at those individuals on the team page shortly. As far as the investment strategy that we have at Times Square, it's not rocket science what we do. It's a bottom-up fundamental stock-picking process with a focus on high-quality investments. And as we go through the presentation, hopefully you get a better sense for what I mean by high-quality stocks. As far as the ownership is concerned, I know the question came up before in terms of ownership for the firm. As an LLC, we are actually still partnered up with our passive financial partner, AMG, affiliated managers group based right outside of Boston. Just as a reminder for the economics behind that, it's a 60-40 split. AMG owns 60% of the firm, we own 40%, but then the economics behind that are actually reversed. It's a top-line revenue share. In other words, AMG does not get involved with our expenses, and it's about 65 to 70% of the revenues accrue to Times Square Capital employees. Now, it is a partnership structure as well, so if you look over on the next page, on page 5, you'll see that AMG does not have any representation on the management committee. In fact, the 2 individuals on the left and center, Grant Babiak and Tony Rosenthal, are the 2 portfolio managers on your mid-cap growth portfolio. You'll also notice that out of the folks that we have here, there is also a high level of employee ownership at the firm, and we think that's certainly helped us in terms of retention of our employees over time. It's a small boutique shop. It's all of 49 people, but 12 out of the 49 have equity ownership. It's never gifted up front. We want to make sure that folks own it over time. And as we look at the investment team, most members of the team on your portfolio are equity partners. And as you can imagine, that's helped keep them at the firm over the long course. In fact, the only update that I have for you from a firm standpoint is our office location. And I'm happy to report that your consultant, Jason Poulos, did the due diligence. He was in our offices last week, and I had the pleasure of meeting him back then. But we used to be, those of you who have been to New York, on 6th Avenue between 45th and 46th Streets. We used to get a lot of flack because we're called Times Square, yet we were 2 avenues removed from our namesake. Well, now we've actually moved back into Times Square proper. Those of you who have been to New York, once again, you'll remember that Times Square is sort of shaped as a triangle. We're right at the southern tip. You all have an open invitation to visit our offices, but apologies in advance as you have to elbow your way past the various incarnations of Dirty Elmo and the Marvel characters before you get to our offices. But the reasons why we moved, everyone in the firm is now based on the same floor. Very important from a cultural standpoint. In the old offices, we were split between a floor and a half, non-contiguous floors, but now everyone is in the same space right now. And believe it or not, we actually pay less for the space today, the 1 floor, versus the floor and a half we had at the old building. Once in a while, real estate does work for you in Manhattan. We're glad to have taken advantage of that, especially since the space used to be leased by an Australian law firm that was, shall we say, in distress. They needed out, we needed in, and it was a very good match from there. Quick peek under the hood on page 6, just to give you an idea of the size of the organization. On the bottom right-hand corner, you see we're about $19.3 billion across all our investment strategies. This mid-cap growth strategy in which you're invested has been closed since 2009. No plans at all to reopen that strategy. About a little bit over $5.5 billion in that strategy through the end of the second quarter. As you look at the other strategies on this page, you'll see we have the very interesting challenge of having most of our bread and butter products closed continue business. Small caps have been closed since 2003. Mid-cap and Focus are closed as well. So a very mature firm from an asset standpoint, even though our spouses may think otherwise. But in terms of what's left open for business, we do have an all-cap growth strategy as well as 2 other international strategies. One thing I do want to stress to the board, those international strategies are not managed by your investment team. It is a separate and distinct team that covers that. Just want to make sure that everyone was aware. Lastly, you heard me talk about our institutional focus. Our rep client list is on page 7. You can see in that middle column in the public fund space, we continue to proudly list the Oklahoma City Employee Retirement System. Thank you again for letting us list you there. You should not be getting any calls from any prospects because we are closed, but it is always nice to have our rep clients in our presentations. In the interest of time, I won't go through every single page in the second section. I promise to just spend some time on 2 pages in particular. First, on page 9, the investment team. I would be remiss if I didn't spend just a moment to review the investment team that we have in place. You can see that Grant Babiak and Tony Rosenthal, again, the 2 senior managing partners at the firm, combined have more than 51 years of investment experience. But I do believe that the competitive advantage at Times Square continues to be the separate and distinct team that we have managing your portfolio. 8 very seasoned sector analysts. When you do the quick math on that right-hand column, you can see that they have an average tenure of 18 years of experience in the business. Now, in the course of my 20-plus years on the buy side, I've seen various complements at other shops. Sometimes you'll see 3, 4, maybe 5 individuals that are helping out a portfolio. Some may be 20-plus years of experience. Some may just be a year or 2 out of undergrad. Now, that's not to impugn the work of recent graduates, but we don't believe in on-the-job training at Times Square at the potential detriment of our clients' returns. We only hire senior individuals to the investment team. I did promise an update in terms of who has equity ownership on your investment team. Everyone on this page, with the exception of 2, are equity partners. And those 2 exceptions, Matt, on this page, you've got Matt DeAlto, the second from the top of the analysts, and then Jim Russo at the bottom of the page. The reason these individuals do not have equity, they're the newest members of the investment team. And by new, they joined back in 2011. Just as everyone else, they need to earn it before we actually give them the opportunity to buy into the LLC. Very quick update on the investment process before we dive right into the numbers on page 11. As I mentioned before, it's not rocket science what we do at Times Square. It is all bottom-up fundamental stock picking. You can see from an eligible market cap range, it's stocks between $300 million and $7 billion. Usually it's about $14 billion towards the top end before we look to start to top slice and aim and reduce the position in the portfolio. 3 basic steps in the process. You can see that step 1, it's identifying good growth companies. There is a heavy, heavy emphasis on meeting with management teams at Times Square. Also gives you insight as to why we have so many people managing your portfolio. You may notice one thing missing on this page, it's the presence of screens. We don't run quantitative screens on your portfolio or any of our strategies. We actually screen by meeting with management teams. Now, granted, it's the most time-intensive way to do things, but we think it's the right way. You have made the decision to place the assets of your participants with us. We believe that, in turn, we should be placing those assets with management teams that we can also trust day in, day out. But also gives you some insights in terms of why we have so many folks on the investment team. So in terms of step 1, what's a good growth company? Strong management team, competitive advantage that's both distinct as well as sustainable. The ability to grow. We look for stocks that can grow their top and bottom lines, so revenue and earnings, by about 15% on a prospective view over the course of the next 3 years. The thesis there is that if you can find stocks that can grow their top and bottom lines at their rate, the stock prices also tend to follow. Final 2 steps, how much should we pay for these companies once we identify them? We do all of our modeling in-house. We do have access to sell-side research, but one thing that our folks love to do is debunk the sell side. And in terms of price targets, we do set price targets on all securities at time of purchase. Usually we're looking for about 25 to 50% upside over the course of the next 12 to 18 months. Not looking to shoot the lights out. We believe that if you can compound a lot of singles and doubles in the portfolio, you let the effects of compounding help you out over the long term. Finally, you have about a portfolio of about 100 stocks when you get to the final product. Now, I want to focus the balance of my time on performance returns. If I can ask everyone to turn past the 3rd tab over to page 16. Timing is everything in our business, and of course, the first meeting that we have together, I do have a period of year-to-date underperformance to explain to you, but thankfully the 1, 3, and the since inception return that goes back to 2010, a good amount of annualized excess return since you have been with us. Now, just some comments on observations that we've made so far year-to-date. We've seen a lot of winners in your portfolio in 2013 reverse course and not participate in the market in 2014. You'll notice some of that when we take a look at the top 10 page shortly. And as far as how your portfolio has progressed so far this year, we've unfortunately underperformed for the first 2 quarters of 2014. And I think there was certainly a low quality effect that drove the market during, especially during the first quarter. When you look at the benchmark here for this portfolio, the Russell 2500 Growth Index, there were a lot of the low quality, as measured by return on equity as a proxy for investment quality, the lowest quality stocks in the benchmark actually drove returns. Now, I offer that just to provide context in terms of the market that we were investing in, not as an excuse. As you know and as you should expect, we basically live and die by stock selection at Times Square, so we'll go into some specific stock examples shortly. But the underperformance year to date has not been due to any fundamental disappointment. I can tell you before looking at sector positioning, we have not made any wholesale changes to the weights in your portfolio. We don't try to take advantage of any short-term moves in the marketplace to shake things up. As we say at Times Square, we'd rather underperform for the right reasons than outperform for the wrong ones. And when you invest with us, you should know our investment process, and you should know that we're going to stick to our guns by staying true to the process for which you've hired us. It's fair to say there was a fair amount of multiple expansion last year. We've seen some of that multiples contract so far year to date, but again, just to give you some insights with what's been happening in the marketplace. Those of you who are curious about the longer-term track record and why you may have hired Times Square to begin with, we do have the longer track record on page 17. I mentioned that SMID-cap growth we've been managing for quite some time. This strategy goes back to the mid-1980s. And again, as far as the process is concerned, it's the old adage, if it ain't broke, don't try to fix it. So we've been managing assets in the same way, and you can see that over the longer term, 5, 7, 10, and going back all the way to 1985, a good strong amount of annualized excess returns for this mid-cap growth strategy. Some comments in terms of sector positioning on page 18. There are a few weights here relative to the benchmark that might seem counterintuitive to you. I come before you this morning as a growth manager, and sure enough, there are some traditional sectors that folks think those are the sectors that growth managers are typically overweight in. But sure enough, if you look at the first sector, consumer discretionary, we're actually underweight in your portfolio, 17% versus 19.5% in the benchmark. So what's going on there? There are 2 main industries that we typically don't invest in consumer discretionary, retailers and restaurants. If you stop and think about those 2 industries, other than access to capital, there's nothing really stopping anyone from launching a new restaurant or retailing concept. Now, we understand we may miss the new Chipotle on the restaurant side. We may miss the new Abercrombie & Fitch on the retailing side. I can tell you I can't even keep up with what my own teenage daughter wears week after week, much less what other teens are wearing. So we don't profess to be fashion mavens at Times Square. We'll leave those kinds of stocks to the more aggressive growth or momentum managers in the space. So in your portfolio right now, we do not have any exposure to diversified retail, nor do we have any exposure to restaurants. Another sector weight that might seem counterintuitive is financials. 18.5% here versus 11.4% in the benchmark. This is a classification issue. Frank Russell, who puts together the indices in their infinite wisdom, has lumped together a lot of business services companies in the financial data and systems industry. A lot of these are payment processors that really aren't taking any credit risk, yet Russell puts them here in the financial services sector. You have stocks here in your portfolio like Global Payments. Global Payments is a payment processor that gets a cut of every single credit or debit card transaction that gets swiped through their system. You also have companies like Jack Henry in your portfolio. Jack Henry is a provider of core processing solutions for small and mid-sized banks as well as credit unions. Healthcare might also be another sector weighting that might seem a bit counterintuitive, where here we are underweight. Again, another one of the traditional sectors of growth. Here it's biotech. The way we view biotech stocks at Times Square is we generally don't invest too much in that space. If you think about biotech stocks, especially as you go down the market cap spectrum, very binary in nature. Many of these stocks do not have any drugs that are FDA approved, so they're not generating any revenues. You have to look at their cash positions to see what the cash burn rate is like. So very much like holding a lottery ticket. Again, we'll leave those kinds of stocks to the more aggressive managers. We prefer the biotech companies that are a bit more developed, already have drugs that are approved, or from solid management teams that we've also known in the past in our career. Some observations in terms of returns in the benchmark. You can see that both utilities and energy are actually the top performing sectors here in the growth space. Over on the energy side, a lot of that's being driven by commodity price strength. And then over on the utility side, as my counterparts from Ernest mentioned, a lot of that is because of investors searching for yield, both in the utilities as well as in the REIT space. Also gives you some indication for why value has been doing so much better than growth so far this year. I did mention that we basically live and die by stock selection at Times Square, so I do want to focus on some specific stocks for you on page 19. You can see this is for the trailing 1 year through the end of July. We wanted to make sure we gave you recent returns. And if you look at that bolded row about 2/3 down, the report that I have to present to you is actually split. Half of the outperformance has come from sector allocation, half is from stock selection. Not a complete win in our view. We prefer more of that. Typically, it's 80 to 85% of the attribution is actually coming from stock selection, but we're certainly not going to complain during periods so we can actually beat the benchmark. But just bear in mind, you should typically see more of that coming from that middle column. Now, if you look at what's been driving in that middle column for stock selection, you can see that it's been financial services, consumer discretionary, and healthcare stocks that have been driving returns in your portfolio. And sure enough, if you look at some of the top contributors on the bottom left-hand side, you'll get a better sense for some of those names. AerCap Holdings is actually the top contributor in your portfolio for the rolling 1 year through the end of July. If you're not familiar with that name, they are an aircraft and basically aircraft leasing and financing. They acquired the same business from AIG. AIG was rolling out of that business late last year. That deal was announced during the fourth quarter. Combined, once they take over AIG's operations, they will become the largest provider of aircraft financing and leasing by fleet size. Last year alone, this stock was up 97% in your portfolio, so definitely one of the big winners to report to you today. The next stock on that list, definitely recognizable, Avis Budget Group. So car rental stock, not necessarily the sexiest stock a growth manager can invest in, but if you think about what's happened in the car rental industry, what used to become a multi-fragmented area has really consolidated over the course of the years down to 3 main providers. I can tell you we will gladly invest in any monopoly we can find, but the car rental space has now become an oligopoly. If you look at the 3 main providers, Avis, which is in your portfolio, has Avis, Budget, and Zipcar, the car rental sharing firm that was recently acquired by them. Over on the Hertz side, Hertz over time has actually acquired 2 other brands as well, Budget being one of them. And then Enterprise, the third provider, is actually private, so it cannot be invested in your portfolio. Why invest in this stock? Well, because in any oligopoly you have pricing power. You can see anyone who's rented a car anytime recently, you can see the prices have steadily come up. They can easily raise rates and folks will still continue to rent from them. I'm certainly glad that I'm on a corporate card when I rent when I travel on business, but so be it. And in terms of the summer months, which tend to be the most important for car rental agencies, the summer months have been strong so far. So it looks like that the thesis is still holding out for these kinds of stocks. One other name that I'll cover for you on the contributor side, Puma Biotechnology. Now, of course, I mentioned earlier that we typically don't invest in biotech names. Sure enough, we have a biotech stock that is one of the top contributors. Puma has a drug called Neratinib, and it's actually a drug that just passed phase 3 approval for FDA. This is for operable breast cancer. There is no other drug on the market right now, and with the way things have been progressing, this is basically a home run for the portfolio. The stock, I can tell you, year to date is up 217%. I wish I could tell you we have most stocks like this. They are few and far between, but we'll certainly take these big winners where we can get them. The reason why we invested in this stock to begin with, harkening back to my comments about biotech, we knew the management team from before. This management has a prior track record of success. They actually had a successful drug that they actually sold to Johnson & Johnson a few years ago, so we basically followed them as they moved over to Puma Biotechnology. We don't always get it right at Times Square, so I would be remiss if I didn't give you a balanced presentation this morning. And just to spend some time on the 2 largest detractors in your portfolio, one name you may recognize, the other one you may not, Newstar and GNC Holdings. Now let's start with the name you may recognize, GNC, the retailer of vitamins and health supplements. Now this was clearly a mistake stock for us. This stock was down during the first quarter. They were hurt by the very tough winter weather environment that those of us in the Northeast certainly experienced. We actually added to the position when the stock was down in Q1. Sure enough, the information came out and got worse during the second quarter. They also announced that a C-level executive is going to be leaving the firm, never a positive sign, especially given our focus on management teams. So we've actually since sold this name out of your portfolio during the month of July. So in case you see a statement through the end of June, it's now out of your portfolio through the end of July. Newstar. Name you may not recognize, but Newstar, this is also very close to a monopoly. They are behind what's referred to as the NPAC contract here in the United States, which is the Number Portability Administration Center. Now, if you or anyone you know has gone to a wireless carrier and tried to port your number over to a new carrier, you would not be able to do that without a company like Newstar. They own the call registry of phone numbers here in North America. So they are the incumbent provider on this contract. They have been so for the last 17 plus years. It's gone out to RFP in the past. They've always won. And in the latest RFP process, which closed, there was another competitor, Telcordia, which is a division of Ericsson, that actually submitted their bid late, yet it was allowed to do so. Washington, D.C. is involved here, and you're never quite sure exactly what's happening under the table, but we were a bit surprised that Telcordia was allowed to submit their bid. Now, over the course of the last few months, there is increased market speculation that, for the first time, Newstar may lose this contract to Telcordia purely based on price. From our past experience, you do not give up a technology contract like this unless there is something fundamentally wrong with the service. Newstar, in our humble opinion, has performed flawlessly over the last 17 years. Just to give you an idea, we've done the due diligence on exactly what Telcordia can do. They do have a similar service that's currently operating in India. Well, guess what? In India, when you're looking to port your number over, it takes 7 days, not a matter of a few minutes as it is here in the U.S. So we will continue to monitor the stock to see how the situation plays out. But because of all the negative headline risk that's been surrounding Newstar, that stock's been down. Unlike GNC, we do still hold it in your portfolio. That NPAC contract is about 50% of their revenues. They do have other business lines. So God forbid, even if they lost the contract, they will still continue to be an ongoing concern as an operating entity. With the balance of the few minutes that I have left, just to go through the last few pages of the presentation, we do have the top 10 holdings for your reference on page 20. Even though we do have a portfolio of about 100 stocks, you do see that this is a conviction-weighted portfolio, so we're not afraid to take larger positions towards the top end. If you look at those numbers on the second column from the right-hand side, the year-to-date return for the top 10 names through the end of July, hearkening back to my comments that a lot of the winners last year have not participated in the market this year, about half the stocks here in the top 10 have outperformed, the other half have not. And if you think about those stocks, if you do the quick rundown, some of those stocks that have underperformed this year, just to give you an idea for how they did last year, Solera, which is an insurance claims processor, one of 3 main providers here in the United States, stock was down 9% so far this year. Last year, up almost 34%. A company like CoStar Group. CoStar, if you're not familiar with it, they are like the Bloomberg of commercial real estate, really in charge of a lot of the data bits that folks have to look at when they work in that space. CoStar down 22% this year. This was the top performing stock in your portfolio last year when it was up 107%. I can also tell you we did take money off the table and trim these positions, but as you can see, the frustration that we've had were names last year that did so well have not been performing this year. ProAssurance, down 8% this year. Last year, up 17. Apollo Global Management, down 11%. Last year, that was your number 2 contributor. It was up 112%. So again, just to give you an idea for the frustration that we've had at Times Square, but we're going to keep on ticking. There was a question before in terms of the size of the portfolio. I can address that on the very next page, page 21. You can see in the middle row, the weighted average market cap of your portfolio, it's about $3.8 billion. We have in the past and expect to continue to run slightly smaller to maybe flat to the size of your index. So here, $3.8 billion versus $4 billion in the benchmark. And then lastly, in case you were curious about any of the risk-adjusted metrics, we do have 10-year statistics on page 22. Your portfolio, of course, is a part of the small mid-cap growth composite at Times Square. And you can see from a risk-adjusted perspective, very, very strong numbers to report to the board this morning. Not just the Jensen's Alpha at 3.7%, but you can see the Sharpe ratio and information ratio very strong relative to the benchmark. And with that, I want to be very respectful of your time. Why don't I stop my formal comments there, and I'd love to take any questions that anyone might have.
Any board members have any questions, Joe? If not, Jake, you got any? Okay. All right. Thank you, sir.
Thanks very much for having me.
Okay.
Thank you.
You're welcome. Thank you. Okay, moving on. Item 3 is approve the minutes of the meeting of July the 10th, 2014. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 4 is receive the report of judgments purchased for the month of June. Motion been made and seconded. All those in favor signify by aye. Opposed, same sign. Ayes have it. 5 is ratify the approval of the payroll for the month of July, and Secretary to make necessary changes on an application. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 6 is approve the claims docket. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 7 is the following service applications, and they are 1, 2, 3, 4, 5, 6, 7, 8, looks like. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 8 is receive the report of death and authorize the payment of $5,000 death benefit and authorize the Secretary to make the necessary changes, and there are 2 of those. Or 3 of them, I stand corrected. Motion been made and seconded. All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 9 is ratify of approval of the following termination of vested rights and receive a lump sum payment to the employee's contribution account. Motion been made. Are there a second? All those in favor signify by aye. Opposed, same sign. Ayes have it. Item 10 is a disability. Counselor, do we need to go into executive session?
You certainly have the option to go into executive session, but Renee and I have looked at this particular claim, and there is really no dispute, or if you want to know more of the facts, you can go into executive session, but it's pretty clear, cut and dry, that he's entitled to the disability.
It appeared to me he's only about a year and a month away from regular retirement for 25 years service.
Yeah.
Does disability, is that non-taxable?
I don't think it is, yeah.
It's not in the line, only in the line, it's not taxable.
Okay.
What's the pleasure of the board?
I think we should have a little bit of evidence and hand out something.
You want to press your mic?
If you have some evidence there, a doctor's report or something,
We do have a,
we could take a look at that so that the board had to consider the evidence.
Okay.
that's fine. It's your choice. I'm just saying it's
Okay.
pretty clear, cut and dry in this one.
Somebody want to go into executive session?
I'll move that we go into executive session to discuss this item further.
Okay. Are there a second?
Second.
Roll call, please.
Jacqueline Adams, Ames, Diana Berry, James Hamel, Dennis Spencer, Randy Thurman, Jim Williamson, Ken Culver, and Debbie Beasley.
Yes. Okay, we retire to the back.
It's available, it wasn't available earlier.
Oh, is it not of? Jim's not here yet.
We have quorum.
We're here for him. I'll entertain it. We'll call the meeting back to order at 11:08. I'll entertain a motion.
I move
On
that
item
we
10.
approve the application of Mr. Holland for disability not in the line of duty.
Second. All those in favor signify by aye. Opposed, same sign. Ayes have it. All right. Item 11 is discuss and authorize A. There's two things here. Let's do them separately. A is send attendees to the Oklahoma Public Funds Conference, September the 24th through the 26th in Norman. And thank you. Renee passed out the tentative agenda for this conference.
That conflicts with the municipal league conference.
Oh, okay. So you won't be able to go?
I'm speaking municipal attorneys on
Oh, okay.
the 24th, and also participating on the 25th. So
All right. Make a motion to move. A second? Second. All those in favor signify by aye. Okay, B is the actuarial service agreement with Gabriel Roeder and Smith and Company. Any questions on that? Motion been made. Are there a second? All those in favor signify by aye.
Aye.
Opposed, same sign. Ayes have it. And 12 is the investment consultant report. Jason, you're on, sir.
Thank you. Good morning again. You've had a long morning, so I'll just try to touch on some things in the
Sound like you
quarterly
got a
report.
cold.
Pardon me?
You got a cold?
I'm ending a cold. Been on the road for a couple weeks, and this is what happens when you're flying on planes with and ending up in seats next to people that are sick. Right. So if you turn to page 16 in the quarter report, I'm just going to go through the total fund overview. As you heard from your two small cap managers, in terms of returns, the equity markets have been very favorable for the last several years, and your managers have done well across the board. But just looking at things on a dollar standpoint, and this is information through the end of June on page 12, you began that one-year period with $572.8 million on July 1, 2013, and ended with $658 million at the end of June 2014, almost $100 million in gains on the portfolio. Net flows from the portfolio were about $13 million, so that's contributions in less payments out of the portfolio. So very good year on a dollar basis. In terms of relative results, if you look at page 17 and you go to the far right, the 10-year numbers, trailing your actuarial bogey of 7.5%, you're up almost 7%, 6.9% over that 10-year period, slightly behind your policy index. Some of that has to do with a little bit less risk in the portfolio. If we roll that a little longer time horizon out to 12 years, you'll see you're actually at 7.5% over a longer term time horizon. So that's you're beating your actuarial bogey, you're beating your policy index, and you're doing it with less risk. In terms of relative to peers, this portfolio tends to stay right at about the median in terms of returns relative to peers. What we're not capturing here is risk, and we do know that from a risk basis, you have less risk than peers, and on a risk-adjusted basis, taking less risk. And I think as you look at funded status, your funded status, I think, what is your funded status right now? 101. At 100% funded, you don't necessarily want to have your foot pressed down hard on the gas. Keeping that, the real objective of a pension plan is to stay as close to fully funded as possible. And so you have, while still being able to generate returns in the portfolio. So you have the ability to take on a little bit less risk. And I don't think being number one in terms of return is the most important thing. But on a one-year basis, up 17% through the end of June, certainly very good period relative to those objectives. And if you flip to page 19, this is what I was referring to. This is a little bit longer time period. Why 12? Well, that's how long we've been calculating performance for you all. In that upper right on page 19, you'll see return in the portfolio at 7.5%. So about right at essentially what that required return is, or your objective, relative to a policy index. And think about the policy index also as a measure of is that 7.5% return reasonable? And I'd say yes, based on you see what the asset allocation would suggest, at least over a long-term period, and you've actually gotten a little bit better. And as you'll see from those risk metrics, standard deviation, quite a bit less risk, 8.5% volatility versus 9.4 for the index. Risk-adjusted returns are Sharpe ratio. Sharpe ratio is a measure of how much return per unit of risk you're getting, so a higher Sharpe ratio, the better. You're getting higher Sharpe ratio than your asset allocation or your policy index would suggest, so that's good. Beta, measure of how sensitive your portfolio is to the direction of the market. And what we're trying to do is have a little less sensitivity to the direction of the market, which is helpful in more volatile times when markets are going down. It may have a little bit of a headwind when markets are going up, but over time it pays off and it protects that principal and that funded status and the volatility of contribution rates, quite frankly. Just moving all the way to page 22. Actually, I'll move to the ASAP now. Looking at asset allocation on the ASAP, I think I was here when I was last here a couple months ago. We had first introduced our new ASAP. Hopefully it's, we're still working. A lot of this is programming, and we're trying to improve things. Hopefully it's, anytime there's change, people are wondering, well, where'd that go or where'd this go? Hopefully this is still understandable and readable. But the first page is just showing where you are in terms of asset allocation at the end of July. The table in the middle shows targets and ranges to the sub-asset classes. So continue to be overweight to equity overall. Primarily that's in large cap equity. That will come down when the new commodities mandate is funded. I think we're just working through some issues on the subscription documents. I think a reasonable timing would be October 1 for funding of the Gresham TAP fund. That's intended to be a 5% target. You'll see down toward the bottom there, commodities currently 0. Target is 5%. That can be fully funded at once. It's not like real estate or private equity that takes time to stage into. So that will come from large cap. And most likely it'll be some combination of the SSGA and INTEC, and we'll work with staff to do that. I think you've been using the State Street funds for your operating needs, and as we look at those, they're getting a little bit out of whack in relation to their counterparts within that asset class. So the SSGA large cap index fund relative to INTEC is a little bit underweight. I think we'd like them to be a little bit closer. And then certainly on the fixed income side, Bob's not here, the core bond fund, the SSGA fund, that's quite a bit underweight even to its target. So I think we'll want to probably adjust that as we fund the commodities strategy. Otherwise, you're generally in line with targets, and you'll be more in line when that's fully funded. The next page on the ASAP, I think, to me, this is a helpful look. It doesn't get so down in the weeds on the managers. It focuses more on asset allocation, what's helping and hurting. And so we break down at the top of the page, you see the total portfolio results. This is rolling 1 month forward. July was not a great month. Equities were down in July. You're seeing a bit of a correction as Joe talked about with Times Square. What worked last year hasn't been rewarded this year, but also what you're seeing is a bit of a pullback in the equity markets, particularly in small cap. Year to date through yesterday now, small cap is actually negative, down about 2%, Large cap, or the S&P 500, is still positive, up about 6%. International developed, as measured by the EFI, is essentially flat. And emerging markets is now the best, but it's still muted compared to last year. Emerging markets are up about 8% year to date. But what we see on this page for your total portfolio, 1-year returns of now about 12%, down from was 17% a month ago, so you're adding a bad month and taking off potentially a good month. But you can, if we go down the line and look at each of the component parts, large cap for the year, a little bit behind, but still up 16.7%, so that's the combination of SSJ and Intech. Your small cap, so the combination of Times Square and Earnest, is over 2% ahead. One of the things that I think it's important to keep in mind here is patience and just the different cycles, and Earnest is a great example of that. You've stuck with them in this strategy you've had since May of '03. The chart that they show with the dollar growth in their book, I think, is always a good chart to remind trustees. One of the things you saw in there was about a $9 million withdrawal from that portfolio. You initially funded with $17 million, you took $9 million out, and now you have $48 million with them. Well, not every period has been good, but that $9 million withdrawal, if you think back to the 04-05 period, they were one of your best performing managers. So you were taking money from them to pay benefits or to rebalance. And then they go through a cycle that's not as great, but then it comes back, as we've seen now, and over the last year, they're in the top 10 percentile of small cap value managers. So Times Square has done very well also. The more recent underperformance, I think, is explainable, but as we look at them from inception, they've done very well. The next two lines really get to the more non-traditional components of your portfolio. The long-short equity, up over 10% for the year. It's actually up 11%. Relative to what's in the policy index that we're rolling up at the total fund level, the policy index is long-only equity. So we're measuring the long-short against the S&P 500, more from a risk standpoint than a return. So when the S&P is up 17% and your long-short's up 11%, that's a bit of a headwind, but the risk there is quite a bit less, and that's when we get looking at longer term, the total portfolio risk is a lot less. Private equity, pretty decent year. Your private equity program is still very small relative to the overall plan, 3%. It's not only is it small, but it's fairly immature in its age, meaning a lot of the companies have yet to see results and taking some of the companies from private to public. But overall, fairly good returns over the last year, over 14%. Relative to your policy index, again, that's been a bit of a headwind. Not intended as a risk reducer. It somewhat acts as one because it's not priced daily, but intended to be a return enhancer, and we think over time, as you build that out, it will continue to be. One area that's been a bit disappointing, and I wouldn't say this is in your portfolio. In your portfolio relative to the policy index, the international managers have trailed a bit, Lazard, Harding Loevner, and Von Tobel. But what we've seen in international space, particularly developed managers, it has been a difficult year for active management. 2013 in international developed space was a lot like 2010 in the U.S. It was a very low quality rally. Some of the things that performed the best in the benchmark were the European peripheral countries, particularly financial, so Portugal, Ireland, Italy, Greece, Spain, those countries that were affected the most in the recession. Their financial sector, banks in particular, have benefited the most in terms of stock price due to the massive amounts of liquidity that the European Central Bank has put into the system. So stock prices have gone up. Doesn't necessarily mean the quality of those companies has improved that much. So your managers don't own those is basically one of the issues, and that's what's done the best in the benchmark. And so we've seen it pretty difficult for active managers across the board to outperform. We think that's starting to change a little bit. Von Tobel on the emerging market side, Similar story, although they do have a lot of exposure to financials, not necessarily, not in developed markets, but in emerging markets. There it's more of a quality, a broader quality issue. Staples, they have a very significant allocation to Staples, about 3 times the benchmark. Staples was one of the lowest performing sectors. They're going to look very different. More recently, their performance has been very good over the quarter, ending, year to date through June, they were in the top 12 percentile. Joe mentioned that I met with Times Square last week. I also was on site at Von Tobel and met with them in New York last week as well, and I think things are certainly going well, and looking forward, I think relative performance should improve. And the other piece there is the Wasatch emerging market small cap. This is going to be a very volatile component of your portfolio. As emerging markets didn't do well last year, they're focused on the smaller caps, smaller names. It's going to be the highest volatility in your portfolio, and they're going to get a lot of upside when markets are going up. They also could underperform a little bit more when markets are down. Finally, the fixed income. Your fixed income composite overall relative to the policy benchmark doing very well, up 6.5% versus the ag up less than 4%. Now, it's surprising, last year the ag was down 2% as interest rates rose. Year to date, we've seen interest rates, 10-year Treasury yields have backed down about 0.5%, so bond prices have gone up, but you're really getting the benefit of the diversification, the non-U.S., the high yield, and some of the alternative credit within your overall fixed income composite. The areas that have contributed the most to this outperformance have been being overweight core bonds, so you have quite a bit in Core Plus, but the brand new Brandywine portfolio year to date is up over 8%. Over last year, up 8.46%, and that's global bonds, non-U.S. bonds. So that's been very additive as well. And then the real assets, which is a combination of some of your core real estate or the Morgan Stanley fund and the small pieces that you have in opportunistic real estate, up 14%, which relative to bonds, the real estate's doing good, a little bit less than equities, but it's certainly very good return. So. At this point, no real manager issues or allocation issues. We're working on getting the commodities strategy funded. I think the plan going forward, again, is just kind of to continue to review existing managers that you haven't had in some time. Not sure if we said September or October, we would bring in next the hedge fund managers, K2 and PAMCO, which you haven't had in a while. So maybe we'll do that in October. Okay. Is there anything on that agenda that would? No. Okay, so we'll plan on doing that if that's okay with the board.
Yeah, it's on the Wednesday, the October.
Okay. Any questions?
Any board members have any questions of Jason? Nothing? All right, sir.
All right.
Thank you so much. 13, comments from board members or staff. Only I say is get with Renee, the ones of you that want to go to Norman. Anything else? Nothing else? We're adjourned at 11:26.